traders, and welcome to a new day trading strategy video of mine. In today's video, we're going to be talking about bias, trigger, and execution. This is a three-step process that I use when gauging whether to enter or exit each of my trades. So the reason I'm doing this video, you can see it was heavily voted upon, and I had also gotten many YouTube comments and Discord chat comments for me to do this video as well. Still not a lot of love for trading books to read. But yeah, I expect that to really never change. Trends typically stay the same. All right, let's talk about what is this three-step process and why would you want to use this? Well, imagine two types of traders. Imagine that one trader just logs into an exchange. Typical retail trader uses RSI and just trades whenever he feels like it. And whenever he goes into a loss, he just holds his position. And whenever he goes into a slight profit, he sells at a profit. Now imagine another trader who uses drastically different indicators, so bias indicators, execution, and trigger indicators all together for entering and planning exit trades, and will only trade when a high probability setup is available. It's a rhetorical question, but which trader do you think in the long run is probably going to be successful? Likely the second trader, as long as risk management is equal between these two traders where they allocate the same amount of capital. Typically, the second trader is going to be more disciplined because this type of setup is going to lead to more discipline and more rule-based and less discretionary. And this can be quite discretionary, where a retail trader going into a loss might reason he doesn't want to take a loss because, let's say, RSI is constantly oversold, so you don't want to sell. That might be an issue. So how can we become the second trader and not become the first trader? Well, that comes in from bias, trigger, and execution. So what are these blanket terms that I'm talking about, and why can they help you? Well, first let's talk about bias. This is not the type of bias where it's, oh, I have a bullish bias, or oh, I have a bearish bias. That's not exactly what I mean. That can be fine if you want to trade that way. If you have a bullish bias, you only buy, you would never sell. That's fine, but this is a bit different. This is actually more of a crowd bias kind of indicator. So it gives an indication of what other traders believe is going to happen to a coin based on previous trading decisions. So if you see a lot of people buying, typically that would mean that they expect the price to go up. They would not be buying at that price if they didn't expect the price to continue going higher. Retail sentiment and institutional sentiment, so the decisions between retail and institution does need to be differentiated because they will be acting, I would say, more negatively correlated, where whatever retail traders do, typically institutions just do the opposite. And the reason this is a lot of times it comes down to liquidity. If institutions need to dump or pump a large amount of volume, they need to find a large amount of volume transacted at the area that they're interested in. So if many retail traders are selling, that's providing a lot of liquidity for buy orders. So institutions can buy in instead of having to use a market order and just wreck through the order book, because if the institutions did that, they'd be buying at pretty terrible prices and might even worse cause a downtrend after all of the orders have been hit. So typically it's best to trade against retail and with institution. This is not 100%. You don't always want to be just trying to screw over or discover what retail traders are doing and then just do the opposite. I would say in the long run, if you do this, you'll probably be profitable, but some discretion is advised when trading against retail and trading with institution. So the pro here is that understanding the psychology behind the market may just be the best predictor. I know this is controversial because everyone has their favorite indicator or their favorite analysis that can work, yeah. It's just that bias will actually give you direct data of what other traders are doing. And if you can interpret that data well, then you can have a gauge of what they're going to probably do in the future. It's not all dandy and rosy, though, for using bias indicators. It requires market timing. So you might get an indication to buy because, like, let's say a lot of retail traders are selling. You need technical analysis. You need your technical analysis tool belt and skill set to have solid market timing. And that's where the other two indications come in with trigger and execution. Because just trading off of looking at bias is probably not a great idea. And one more issue with bias is that it's not always 100% clear of what's going on. The signal of the noise with this type of indicator is probably going to be the hardest to differentiate. Because really what you're looking at is the actions of many different kinds of traders. So you need to discern when this is a crucial point in the market where I should probably be trading a reversal, or this is probably not as important and the trend's probably just going to continue. And that just takes a lot of practice in trying to determine where those things are happening. So here are some bias indicators that I've mentioned. I think I've covered all 6 of these, I think, except the last one. I've covered 5 of 6 of these on my channel. So just standard stuff. Bitfinex margin longs and shorts. This is just going to give you the retail sentiment for what traders who are taking on leverage are doing. Order flow, I put that as both because that's going to give you an indication of both institution and retail because it's just looking at volume and order book changes, which makes sense. You probably want to look at market buying and market selling to get an indication for retail, and then you probably want to look at large orders and spoofing to look at for institutions. Volume, again, of course, volume is just going to be both. Typically, you will see high buying volume at market tops and high selling volume at market bottoms, but volume is a pretty versatile indicator that will just give you an indication of transactions that occur. Volume-based indicators go a little bit more complex, but not too complex, like OB, on-balance volume, Elders Force Index. These will give you both retail and institution, and if you can really discern what these indicators mean, you could even try to signal out a retail move versus an institutional move if you really understand those indicators. Google Trends is a great way to look at retail traders or traders who have never traded before. Because when you see a Google search trend like how to buy Bitcoin or Bitcoin bubble, typically, more often than not, that's going to be a lot of retail traders who are Googling to find answers from other people. I wouldn't imagine that scores of institutional traders are going to be searching that, and if they do search it, they're probably more curious about who is searching that than the actual search term itself. Finally, we have StockTwits and Twitter. So StockTwits and Twitter are both going to give you just a feed of people bullish or bearish, especially StockTwits. If you go there and just type in Bitcoin, you can find it. You can find how many people believe it's going to go up, how many people believe it's going to go down, and that can just give you like a ground floor analysis of where the retail head is at. Again, this might be a small sample size though, so be careful, with what you read. Okay, so we've gone over bias indicators. Let's talk about triggers. Triggers are, I would say, technical indicators that really everyone who has traded in the past is familiar with. These are just traders that give an indication whether to buy or whether to sell. Retail traders love using these. So these types of, I'm going to get into what exactly these are, but these types of indicators do reveal valuable information about past price movements that can be used to infer future price moves. That's the whole purpose of technical analysis. There are some issues with just using triggers though. Many retail traders like to use the same indicators, and institutions know when many retail traders are going to be buying and selling. And remember my previous example where I said institutions need to, when they want to buy or sell into the market, they want to not have a large impact. They don't want to buy with a market order and tear through the order book. No, that'd be unprofitable. They want to buy at, in their case, hopefully one price where they can just put a bid wall or an offer wall and get many retail traders to buy or sell that offer wall. So when some indicators occur, when like let's say RSI goes oversold or overbought or EMA crossovers, not always, but sometimes you might see institutions that are just trading right against the crowd so that they can dump or pump their liquidity. So that's just one con that you just need to be careful with when you're trading with trigger indicators only. And finally, typically market orders are used. I know some people might use limit orders, but when you get an EMA crossover and price begins to go up, typically you're going to be using a market order. When you get MFI oversold or RSI oversold and then price dips and then begins to go up, typically you're going to be using a market order, which is going to be buying at a worse price and buying with more fees. There are many different types of trigger indicators, and I probably do not even have half of the ones that you can probably think of. But I'm just here showing the most important ones or the ones that I'm familiar with. So some of these do fit into other categories like divergence and overbought, oversold. RSI can be fit into both. Same with Bollinger Bands that can be used with volatility and then can also be used with crossover as well. So yeah, so these are just the main trigger kinds of types of indicators. I did include candlestick strength and momentum because some traders do like to trade using candlestick strength. But yeah, so those are just the basic trigger indicators that most traders would be using or familiar with. All right, let's get to the final part of bias trigger and execution. So executing indicators dictate an exact price or a price area to buy or to sell at. The good news is this is used by both retail and institutional traders. So retail traders do use volume profile, Fibonacci, support resistance, and institutions do use that as well. Another pro is that limit orders are almost always going to be used with this strategy. If you're given an exact price to buy at, typically you're going to put your limit buy order around there. Maybe you could wait for price to dip down and then market buy when price goes up, but you're going to be probably making the most money if you use limit orders. That's going to lead you to catch better prices because if you're buying with a limit order with an execution indicator and price goes down there and hits it, you're going to be making more money than, like, let's say a trigger indicator where price gets triggered here and then price goes up that level that you would have bought at with a limit order, and then you market buy here at a worse price and with more fees. So that's just my little thing on limit orders versus market orders. So these are going to give you clear entry placement opportunities, as you can see here. Of course, with every pro, there must be a con. The con here is that execution indicators are not always fantastic for dictating when to take a loss. So you might buy into a position with, like, let's say Fibonacci's, and then if you do place a stop loss, where exactly do you place it? You might have to use support resistance levels for that, which you could use. The issue with that is that there's high subjectivity. So even worse, if you don't place a stop loss and you buy with an execution indicator, you might never get an indication to take a loss, and thus you could become trapped in a position. Another issue with this is just overall subjectivity. How do you draw your volume profile? How do you draw your Fibonacci's? What support and resistance matter? What points don't? There's a lot more subjectivity when it comes to this than when it comes to trigger indicators. So these include 5 ones that I've come up with. Again, there are plenty more that you can think of. Just standard Fibonacci's, wave projections, volume profile, support resistance level. For example, if price is in an uptrend, typically you want to buy at the previous resistance level, at the top of the previous resistance level, because that will become support. Price breaks previous resistance, then it typically comes back and treats that as support and then continues upward. Then order book as well. So if you see a lot of orders are at, like, let's say 7,800, and that could give you an indication that you might want to buy it around 7,801 or 7,810 or somewhere around there to front run that order. And that could be used as an execution indicator. So one thing that you might be asking yourself is, isn't blah, 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 both bias and trigger, isn't volume profile bias and execution? Yes, these are just more blanket terms. This is not hard categories. Because a lot of these indicators not just are going to be moving around with different subsets within their own, like trigger indicators. We have like, oh, it's divergence and overbought, oversold because it's RSI. Not even that, but some of these indicators you could even argue fit into all three, right? That's not the important part. The important part is trying to find indicators that work well together and not use indicators that probably are giving you the same information. So what I want to do for the finality of this video is just identify the 3 main types of traders. So we have hobby traders, we have part-time, and we have full-time traders. Hobby traders, if you want to, you can really use any one subset and just trade and try to learn about the market. If you take some losses, it's fine. Part-time traders who are trying to make a part-time income or just doing it to make some side money, either way, I would recommend to use 2 subsets. So to either use bias trigger, to use bias execution, maybe use trigger and execution. So you might be doing hey, I'm using RSI volume profile and Fibonacci's, good. Or hey, I'm using Google Trends, retail sentiment with Bitfinex margin long and margin short, and I'm using Fibonacci's and volume profile, good. Full-time traders, I would highly recommend to use bias with trigger or with execution, or use all 3. I don't personally know too many full-time traders who just use one indication, so who just use, like, let's say EMA crossover, or just use RSI oversold, overbought. That's probably not it's not a bad way to trade, but if you're trading full time, then you're going to want to have more information about the market that you're trading. So that's why I say that you want to combine bias with either trigger or execution, or you could just use all three. An example of using all three of something that I do, you could use order flow, retail sentiment, and then you could combine that with trigger indicators such as MFI and ATR, average true range. And then you could combine that with executions such as occasional volume profile and heavy use of Elliott Wave 3 and Fibonacci's. That would be a good full-time setup. And finally, be careful not to use too many indicators within the same category, because this could lead to confirmation bias, where let's say RSI goes oversold, MFI goes oversold, CCI goes oversold, stochastics go oversold, and everything, it looks like there's a 99% chance of price going up from there. That might be an issue because you're using too many of the indicators that are the same category. It might be best to just look at different kinds of indications to find if it's a high probability setup. And finally, of course, happy trading. So far, I would just like to thank my Patreons who voted upon this topic, and I would also like to thank my viewers for subscribing and helping me out through the way. Have a nice day.